How is it going? Welcome to Tanner Talks About Stuff That Happened. I'm Tanner, and I'm going to talk about stuff that happened. Today, the stuff that happened that we're going to be talking about is called Black Tuesday. That is October 29th, 1929, and it is a bad day to be an investor at the New York Stock Exchange. So what exactly happened? We've heard a lot about the Great Depression. We've heard about the stock market crash of 1929, but what happened and how in the heck does the stock market work? That's what we're going to talk about today, so let us dive into it without further ado. The idea of investing in a company, buying and selling stock in a company has dates back further than you would think. And actually, the first recorded instance of this is 1602. It might go back further than that, but that's the first recorded instance, and that is with the Dutch East India Trading Company, and hope that the company did not decrease in value while you had that stock. But the East India Trading Company was growing exponentially, but financing all of these voyages across the world was not cheap. So the concept they came up with was that people could finance their voyages, and in compensation, they would get a share of the profits of the voyage and the goods that were traded. So you would give $10 to this voyage, and you would say, okay, I get my $10 back when this comes back, and I get a share of whatever the profit was from the voyage, hoping that the voyage was successful. If the voyage was not successful and they did not trade as much as they expected to, you could lose money on your voyage. As this ideology caught on, there became a need for an organized marketplace, and this actually happened in London in 1773, and stock traders started meeting at a London coffee house, where they eventually changed the name of the coffee house to the Stock Exchange, took over the entire coffee house, and made it into their own hub of industry. That was the first exchange. They changed the name of the coffee house to the London Stock Exchange, and that was... Like I said, that was founded in 1773. The idea became so popular that it made its way all the way over to Philadelphia, and Philadelphia had an exchange that was started in 1790. Now, these are not stock exchanges that we're extremely familiar with. The one that we are most familiar with is the New York Stock Exchange on Wall Street. I've actually been there, and it's a big foreboding building. The New York Stock Exchange was founded in 1817. And since then, it has become a symbol of capitalism in America and around the world. So to give you a simple rundown on how a stock market works, it was created to keep struggling businesses afloat by giving them a source of income that makes it easy for anyone to invest. Anyone from a shoe shiner to a tycoon could invest in the stock market with the creation of the idea of a stock exchange. So when you purchase a stock in a company, you then own a small share of that company. If you buy a $5 stock, you then own $5 worth of that company. If the company increases in value, your share of the stock in the company increases in value. Just likewise, if the company falls in value, your share of the stock decreases in value. When a lot of people go and buy a certain stock, the stock price goes up because the company has more money to invest. But if many people sell at the same stock, the stock price goes down. So let's do a hypothetical to put it into ideal numbers. Hypothetically, you buy a stock in your number one favorite company. You buy one share of stock. The stock is $100. Then in the next month, the company releases reports of a huge success. Now, because the company has released a report that says that they are being very successful, a lot of people will want to buy that stock because they want a cut of whatever it is the company is doing right. So your stock price goes up 10%. That is a very sizable return, very unlikely to happen in 1 month, but it does happen. So your stock price, because so many people want a piece of that pie, just went up 10%. The money that you spent to buy $100 worth of stock is now worth $110. You sell your share of stock and you get a $10 profit. You really didn't even have to do anything at all. Just because you put your money into the company grew, you took your money out of the company after it grew, and you made $10. That's how the stock market works. Before we get on to the exciting date known as Black Tuesday, we do need a little bit of exposition for what was going on at the time. In the 1920s, we were in a period of time in the United States called the Roaring Twenties. Now, what that means is that consumerism was at an all-time high. People were buying and buying and buying. Because there was so much purchasing power going on, companies were making money and could pay workers more because they were making so much money. And the more workers got paid, the more they could buy. The more they could buy, the more money the companies made. It was a cycle and everyone was making money. Once people had what they wanted, they decided they wanted to invest in the stock market. And because of this, the stock market boomed. In 1924, there was a 20% return. Now, what this means is that if you had $100 in the stock market if you put it in the beginning of 1924 and took it out in January of 1925, you would have $120. Now, imagine if you had put $20,000 in the stock market. This was an enormous return. In 1925, it was very little different. There was a 16% return. 1927, there was a 26% return. In the span of 3 years, people's money was doubling and just becoming an enormous quantity of cash. And the more cash they made, the more they wanted to put into the market. So it was booming. At this point, banks started borrowing money from people who had it socked away in their vaults. And these banks were also buying shares of stock on their own. People started taking out huge loans from those same banks to put into the stock market, and banks were rolling in the interest. That's how excited people were to invest. The more people invested, the more they wanted, and the more they made sure that they got. The amount of money that was flooding into the stock market was unbelievable and completely unprecedented. That's where we get to 1928. From January 1928 to January of 1929, there was a 60% return in the stock market. I don't know if there's been a return like this, certainly not in my lifetime, but my goodness, 60% return rate. If you put $10,000 in the stock market, you would walk away with $16,000 without doing a thing. That's unbelievable. Now, at this point in the historical narrative, things start to slow down. At this point, everyone had a Ford Model T, and Ford wasn't pumping them out like they used to. People weren't buying them. They already had them. The invention of the electric vacuum and the electric toaster had caused another big boom in business, but everyone had one now. These companies just weren't selling as much product as they were at the beginning of the 1920s. Everybody had it. And because there was so much investment going on, innovation wasn't capitalized on. People were too excited about making money. There was no need to invent new things because you could just put your money in the stock market instead. You didn't have to innovate. So there were no new inventions going on that people wanted to buy. They just wanted to keep putting money in the stock market. In 1929, companies start releasing their revenues with disappointing results. It's not as exciting as maybe a lot of stock market investors would have liked, but the stock market is still rising for some reason. Why is it still rising? Well, because people keep buying, because people keep the faith up that the stock market will continue to reward them. And from January to August of 1929, there's a 19% return rate. It's looking like another big year for the stock market. Not quite as big as 1928, but still looking good. So people continue to invest until something happens. In September of 1929, investors start to see that something is not quite right here. Companies aren't making as much money as they used to, and so we have decided to pull out. They start to withdraw their money. They start to sell their stocks off. And for the first time in this entire decade, there are more stocks being sold than there are stocks being bought. So the value of the stock starts to decrease. Not quite as quickly as it will, but it starts to decrease. From the end of September to the end of October of 1929, the stock market becomes the most volatile it has been in an entire decade. Stock prices fall 10%. This isn't extremely alarming because they have fallen slightly in the past, and they always do rebound. Stock prices have dropped a little bit, so that means more people will buy, right? Well, not quite. From September to October of 1929, there's a couple scares. It's not rebounding. The market's not rebounding. It drops 1%, 2%. It comes up again another percent or 2%, but then it falls down. It's not rebounding. So what's happening? This brings us to Black Thursday. This is not Black Tuesday. We'll get to that in a moment, but this is Black Thursday, October 24th, 1929. At the beginning of the day, the markets open to an 11% drop in value of the Dow Jones Industrial Average. If you remember, in September, markets fell 10%. This is 11% in a single day. One day. Not a good day to be an investor. Now, through the next couple days, the markets start to rebound just a little bit. Friday and Monday, the markets come up a little bit. People see that the value's down, so they want to buy, because if they buy now, the markets will continue to go up. People had faith in these markets until Black Tuesday. On Black Tuesday, the markets opened and investors traded 16.4 million shares of stock. They lost $14 billion on the New York Stock Exchange in a single day. Today, that would be $206 billion. On Black Tuesday, the Dow Jones Industrial Average dropped 23% in a single day. During the day, it was absolute pandemonium on the floor of the New York Stock Exchange. Buyers were roaring and screaming. Some even collapsed to the ground when they got the bad news about a stock price. There were crowds forming outside of the stock exchange. Even the police were called in to keep order. Another reason for this absolute panic was this new method of buying stocks called buying on margin. What investors could do is they could place huge stock orders with only 10% to 20% down. They used money that they were borrowing from stockbrokers who were doing the buying and selling on the floor of the stock exchange. When the stock prices fell, brokers started calling in loans. A lot of people who were investing found that paying off these loans wiped out their entire life savings in a single day. Black Tuesday's losses destroyed confidence in the economy. The loss of confidence eventually led to the Great Depression. People thought that the stock market was the economy. They thought that's how we gauge how we are flourishing as a country. And when it completely collapsed, it didn't fall. The stock market collapsed. What do we do now? In the next 2 years, the Dow Jones Industrial Average would lose 90% of its worth. People lost everything on the stock market. And let's get talking about those banks who had borrowed money from lenders, or not from lenders, but from people who were putting their money into banks, thinking it was safe. Banks had used that money to buy stocks of their own. The stock market collapsed. Eventually, banks were shutting down left and right. People were flocking to banks to try to take as much of their money out as they possibly could, getting only 10 cents on the dollar back. Even if people had no money in the stock market, they were still losing their entire life savings because banks had gambled on the stock market. That's how disastrous this collapse was. And remember how we were talking about the consumerism cycle? People had no money to buy, so companies had no money to pay their employees. They were firing employees, they were downsizing, they were paying employees less, so people had even less money to buy. So companies had to downsize even more. Companies were shutting down. No one had any money because there was no money to be found. Everyone had been buying on credit. 10 to 20% down, right? We don't have to pay it all right now. Let's pay it all when we have our investment done. But when the market collapsed and everybody sold all their stocks, there was no money to be had. You had to pay it with your life savings right now. You had no money left. It was a disaster for the American economy. The stock market didn't regain its former glory all the way until 1954, post-World War II, and the big boom that happened after World War II. 1954, 35 years after the stock market crash of 1929. Black Thursday and Black Tuesday. It led to the biggest global economic recession the world has ever seen. It has never been paralleled before or since. And I can only hope that it won't be paralleled. So, ladies and gentlemen, don't buy on credit. Please. I really don't want to have to see another Great Depression. But if you want to invest in the stock market, I highly recommend it. In fact, I would recommend shooting for a long-term investment. That's the best way to do it. Stock market always rises over time. Might be 10 years, might be 20 years, but it will rise. And the best thing to do is just hold your money in there and forget about it for as long as you possibly can. Until you need it, of course. So, this has been Tanner Talks About Stuff That Happened. I'm Tanner, and I have been talking about stuff that happened. I hope you enjoyed my episode about Black Thursday, Black Tuesday, and a little bit touching on the Great Depression. I will see you next week. This is Tanner talking about stuff that happened, signing off.